People keep saying this is 1999 all over again. Bubble, crash, .com 2.0. But what if the scarier truth isn't a quick pop, but 10 years of going nowhere? That's what we need to talk about. Welcome back to Unfoolish Investing. I'm Victor. Today, we're diving into a brutal question. Is this market more like 1999 or more like the decade that followed from 2000 through 2012? Think about it this way. A crash is like ripping off a Band-Aid. It hurts, but it's fast. The lost decade was like pulling that Band-Aid off one hair at a time for 12 consecutive years. So let's break it down. Where valuations stand, how concentrated the market has become, why AI is both the rocket fuel and the landmine, and what lessons we can actually use as investors today. 1999 was wild. Pets.com, commercials at the Super Bowl, all about Pets.com. Companies going public with no profits, sometimes not even revenue, and still doubling or tripling on day one. Then the bubble burst. The NASDAQ lost 80% of its value. The S&P dropped 50%. Brutal! But here's the part people forget. From 2000 to 2012, the S&P went nowhere. Zero. Nada. For 12 consecutive years. Microsoft, Cisco, Intel, even Amazon. Real companies making real profits. Their stock prices were flatlined. Or they fell. That's the comparison smart analysts are making today. Not the bubble pop, the slow grind afterward. So let's talk numbers, but we're going to keep it simple. The Shiller Cape, basically a long-term price tag for the market. It's around 39 right now. That's almost, not quite, almost as high as it was in 1999. Historically, when you buy at these levels, your 10-year returns are weak. The S&P forward PE is currently sitting at 22. That means you're paying $22 for $1 of earnings. Meanwhile, U.S. Treasuries are paying you nearly 5% with no drama. Think of it like this. You're walking into a steakhouse. The menu says $200 for a burger, but right down the street, you got a Five Guys. It's selling you that burger for $10. The question is, how much better can that $200 burger be? That's today's market. It might taste good, but the price is insane. So here's the kicker. Just 10 companies make up almost 40% of the S&P 500. Apple, Microsoft, Nvidia, Amazon, Google, Meta, Tesla, Berkshire Hathaway, Eli Lilly, and Broadcom. Palantir's getting up there. If Nvidia even sneezes, the whole market catches a cold. Back in 2000, I've said this before, Cisco was the stock, backbone of the internet. Everyone owned it. 20 years later, Cisco has never gotten back to its .com highs. That's concentration risk. That's the danger of putting all your eggs in a few baskets, no matter how shiny those baskets look. Now the AI mania, let's talk about that for a second, because those are the shiny baskets. Microsoft is spending $80 billion this year on AI data centers. Google is at $85 billion. Meta, somewhere around $70 billion, but I wouldn't be shocked if Zuckerberg spent more. In Nvidia, the picks and shovels play just made $44 billion last quarter in data center sales. This isn't pets.com nonsense. This is real money. But here's the question. Does it pay off? It's like Vegas. You're building the biggest casino in the desert. If the tours show up, jackpot, you win. If not, you've just built the world's most expensive empty building. Right now, investors are betting the tourists will show up. So, what did 2000 to 2012 markets really look like? Well, valuations, they were compressed. Prices cooled off. Even earnings hold up. The market chopped sideways. You get mini booms, nasty busts, in years of flat performance. Policy shocks? Yep, those came too. Higher interest rates? Sound familiar? Government debt drama? Inflation scares? Those kept dragging returns down. Does it sound familiar to what we're in right now? That's the slow bleed. It's not exciting. It's not headlines. It's worse. It's boredom. Imagine owning Apple, Microsoft, and Tesla for 10 years, and your account balance doesn't move. That's the risk. What could break this entire analogy? Well, it's not all doom and gloom, right? Let's be fair. There are ways this story could be different. If Microsoft turns its $80 billion into AI subscriptions, people are actually using every day. Maybe multiples hold. If Nvidia keeps shipping GPUs like hotcakes, maybe the earnings outgrow the price tag. If Apple finds a way, yes, I'm looking at you, Apple, to make consumer AI mainstream, that's a game changer. We're not talking just iPhones, but in everything we do. This could escape the lost decade trap. But, and I'm looking at you, Zuckerberg, if Meta blows cash like it did with the metaverse and everything else that it's ever done, if Tesla keeps missing the robo-taxi dream, which I think it's going to, if Amazon's cloud margins get squeezed, history rhymes. So what do we do? As unfoolish investors, actually do. First, don't chase the hype. Nvidia at $44 billion a quarter sounds amazing, but Cisco sounded amazing too in 2000. Buying at the wrong price can give you dead money for years. Second, stick to your process. Dollar cost average. Diversify. Own the boring stuff too. Healthcare, staples, maybe even bonds. Third, zoom out. Investing isn't about this quarter or next quarter. It's about whether your money grows steady over decades. Don't let AI headlines knock you off course. So here's the real hard truth. Apple, Microsoft, Nvidia, they're not pets.com. And I keep on using pets.com because I'm from New England and Gillette Stadium had it right across the front. All the .coms until they had to take them all down because they all went out of business. Apple, Microsoft, and Nvidia are real, profitable giants. But even giants can give you a lost decade if you buy them at sky-high prices. So be patient, be disciplined. Don't get drunk on the hype. And remember, empathy first, ego second. Because kindness is a strategy, not a weakness. Let's move forward together, the unfoolish way. Thank you.